The modern electric grid is defined by its sheer physical mass, millions of tons of steel, copper, and specialized hardware spanning thousands of miles. Translating that physical reality into financial mathematics is where standard valuation models usually break down. Take Edison International, trading right now at $73.69 a share. By 2030, this single holding company will deploy between $38 and $41 billion in capital expenditures, primarily to harden the Southern California distribution grid against wildfires and prepare it for mass electrification. For institutional tech investors or retail value buyers, committing $40 billion in capital to a single infrastructure project looks like a massive liability. It breaks every capital-light valuation framework taught in modern business schools. To determine if that massive spend is a liability or an asset, we have to run Edison International through a strict valuation gauntlet, testing the stock against 4 historically proven, conflicting financial lenses. Every calculation we run relies on hard data from the company's July 2026 8K, their Q4 2025 earnings report, and their official 2026 cost of capital application to California regulators. Surviving this gauntlet will definitively prove whether Edison International operates as a capital-destroying debt trap or a legally guaranteed compounding growth engine. The first analytical filter belongs to Warren Buffett. He looks for geographic monopolies, legislative protection, and predictable returns on equity. Edison easily clears the first hurdle. Through its subsidiary, Southern California Edison, it holds a state-sanctioned monopoly over a 50,000 square mile territory. Competitors cannot legally build parallel infrastructure. The legislative moat is equally robust. Recent California regulations, specifically Assembly Bill 1054 and Senate Bill 254, establish a $21 billion wildfire fund and place hard caps on utility liability, effectively neutralizing the company's single largest existential risk. That protected status translates directly to earnings reliability, evidenced by Edison's 22 consecutive years of dividend growth. When we measure return on equity using 2024 shareholder equity and 2025 core earnings, the yield approaches 12.9%. That actively exceeds the 11.75% authorization they formally requested from the California Public Utilities Commission. But the Buffett model flags a massive risk: $29.2 billion in long-term debt sitting on the balance sheet. For an unregulated business, that debt load is fatal. For a utility, it is structurally secured by the rate base, allowing Edison to safely maintain a 15 to 17% funds from operations to debt ratio. This formula illustrates Buffett's strict owner earnings calculation. You take net income, add depreciation, and subtract capital expenditures. With Edison deploying over $7.5 billion in CapEx annually, the formula bleeds deep red. Applied strictly, a utility generates negative, uninvestable owner earnings. But Buffett understands that utility growth CapEx is added directly to the authorized rate base. He views this deployed capital not as an expense, but as a mandatory expanding bond guaranteed to yield an 8.5% weighted average cost of capital. Combining a current 4.8% dividend yield with management's 6% baseline earnings growth target generates a highly predictable 10 to 12% total annual return. Despite those guarantees, Buffett's methodology requires a strict 15% margin of safety on the purchase price to absorb macroeconomic shocks. Edison is a textbook monopoly, but a strict disciple of this framework won't initiate a position until the market price drops to exactly $62.60. Our second filter applies Peter Lynch's growth at a reasonable price methodology. Lynch categorizes stocks into strict typologies. Edison functions as a classic stalwart, a massive, slow to medium growth enterprise that pays a heavy, reliable dividend. To value a stalwart, we use the PEG ratio. We take the $73.69 share price and divide it by the $6.55 earned per share in 2025, giving us a price-to-earnings ratio of 11.25. This scatter plot compares that multiple against a company's growth rate. When we divide the 11.25 PE by Edison's 6% growth target, the stock plots exactly at a PEG ratio of 1.87. Lynch mandates PEG ratios under 1.0. At 1.87, Edison is statistically expensive for the amount of growth it provides. There is also a qualitative requirement for stalwarts. They must be ignored or underfollowed by Wall Street analysts to provide a retail investor with an informational edge. As a $28 billion mega-cap utility with heavy institutional ownership, Edison completely violates the underfollowed rule. Under the Lynch lens, Edison is a definitive pass. The framework proves that heavily regulated, asset-intensive utilities simply cannot generate the hidden growth multipliers Lynch requires. The third filter relies on Benjamin Graham's uncompromising, asset-heavy defensive screener. Edison immediately triggers the first half of Graham's checklist. It has massive scale at a $28 billion market cap, backed by a fortified financial condition and decades of earning stability. It clears the remaining parameters easily: 22 years of uninterrupted dividends, a moderate 11.25 PE ratio, and a price-to-book ratio of 1.45. Because Edison passes the defensive screen, we apply the Graham intrinsic value formula, which prices a company based entirely on its current earnings and its book value per share. This mathematical formula calculates intrinsic value by taking the square root of 22.5 multiplied by the $6.55 in EPS, multiplied by the $50.73 in book value per share, resolving to an intrinsic value of $86.46. Comparing that calculated $86 against the current market price of $73.69 reveals a built-in 14.7% margin of safety. Graham would confidently buy Edison today. The strict quantitative logic confirms that asset-heavy utilities excel in book value-oriented defensive frameworks. Our final filter applies modern discounted cash flow modeling, the exact standard utilized by contemporary Wall Street analysts. A standard free cash flow to firm model calculates valuation by subtracting capital expenditures from operating cash flow. This split-screen model contrasts the $36 to $38 billion in operating cash flow against its $38 to $41 billion in planned capex. The result is structurally negative free cash flow. To bypass the distortion caused by mandatory regulatory spending, analysts substitute a dividend discount model to accurately value the equity. We input the projected 2026 dividend of $3.51, apply an 11.75% cost of equity, and assume a highly conservative 6% terminal growth rate based on management guidance. The dividend discount model outputs a conservative fair value of $61.04. To double-check this, analysts apply a standard comparable price-to-earnings analysis, assigning the sector average 14x multiple to the stock. Multiplying 14 against the 2026 earnings guidance midpoint of $6.05 reveals a starkly different fair value of $84.70. This sensitivity table isolates why modern mathematical models produce such extreme variance. They are hypersensitive to macro interest rate inputs. Tweaking terminal growth to 7% pushes the value to $73.89, while dropping the cost of equity to 10% rockets the valuation to $87.75. Modern DCF and DDM models do not provide a single objective answer for utilities. Instead, they act as a precise barometer for the market's belief in future interest rates. This matrix aggregates the conflicting data points to establish a single, actionable perspective. The valuation spread is massive, stretching from $61 to $86. The $80-plus valuations are anchored by highly predictable bullish drivers, a guaranteed 7% annual rate base expansion, and 22 years of relentless dividend reliability. Those targets are capped by severe bearish risks. Despite the protections of AB 1054, catastrophic wildfire liabilities constantly apply a discount to the stock. Additionally, management must successfully fund a $40 billion capital plan through 2030 without issuing new equity, navigating a debt market that may remain higher for longer. At $73.69, Edison International is an exact hold or accumulate. It is fairly valued on blended metrics. It offers a mathematically verified margin of safety for defensive Graham investors, but it lacks the severe discount required by strict Buffett or DDM models. This line chart tracks the institutional trigger. If broader market conditions push the stock price down, the moment it drops below $62, it becomes a universal, cross-framework, strong buy. Below $62, the DDM and Buffett models align perfectly, while the Graham margin of safety pushes past a massive 25%. Analyzing modern utilities requires abandoning strict free cash flow dogma. To value Edison International accurately, you have to recognize the regulatory rate base as the ultimate driver of intrinsic value. This matrix aggregates the conflicting data points to establish a single, actionable perspective. The valuation spread is massive, stretching from $61 to $86. The $80-plus valuations are anchored by highly predictable bullish drivers, a guaranteed 7% annual rate base expansion, and 22 years of relentless dividend reliability. Those targets are capped by severe bearish risks. Despite Assembly Bill 1054, the threat of catastrophic wildfire liabilities constantly applies a discount to the stock. Additionally, management must successfully fund a $40 billion capital plan through 2030 without issuing new equity, navigating a debt market that may remain higher for longer. At $73.69, Edison International is an exact hold or accumulate. It is fairly valued on blended metrics. It offers a mathematically verified margin of safety for defensive Graham investors, but it lacks the severe discount required by strict Buffett or DDM models. This line chart tracks the institutional trigger. If broader market conditions push the stock price down, the moment it drops below $62, it becomes a universal, cross-framework strong buy. Below $62, the DDM and Buffett models align perfectly, while the Graham margin of safety pushes past a massive 25%. Analyzing modern utilities requires abandoning strict free cash flow dogma. To value Edison International accurately, you have to recognize the regulatory rate base as the ultimate driver of intrinsic value.